All right, good morning. Today is February 8th, 2023, and I'm back with another edition of the Wednesday Live Show. And a lot to talk about today, but I'm going to try and keep it relatively brief. So, yesterday was a very strange day. Yesterday was the day that Chairman Powell was speaking in front of the Economic Club of New York, and it seemed like the market was waiting to hear what he said. And the last time that I did the show, as you recall, last week was Fed announcement day, and of course they raised 25 basis points, which was what was expected, and the market rallied big time. um, Actually, it was a pretty wild day. The market seems to have this sort of recent phenomena of being really extremely dull for a period of time, waiting on something, waiting on some kind of news. So, but we've seen. I guess it was like this past Monday and Tuesday. Um, there was a couple of days where geez, like it seemed like summertime trading, right? I mean, the market was just in a chopping up and down in a really narrow range for basically, two entire sessions, and so and then all of a sudden, yes, it was waiting, I guess, on Powell's comments yesterday, and then there was a huge spike up, and then a huge reversal, and then it ended up going back up, and so we've seen a lot of this. But like I said, last Wednesday, um, and the funny thing about this is, I listened to it, most of it, and watched the market reaction, and I thought that it was just kind of weird because they say that the market likes to fool the most people or whatever, but it was just so funny because it seems like everybody, it seems like the market interpreted what Powell said as like really dovish, when in reality it didn't seem like it to me, right? And I went back and read a couple articles about what he said, and basically basically, the big thing last year, the rallies. Speaking of which, let me just go ahead and pull up the. I got a weekly chart here. Weekly chart's actually kind of interesting with the trend lines marked on it. But these rallies last year, um, the one in July, that big rally, and then also the one towards the end of the year, were seemingly predicated on the idea that the Fed was going to pivot. You kept hearing all this, will the Fed pivot, this and that. And then it became sort of this thing about, the Fed slowing the pace of interest rate hikes, which only makes sense. I mean, what they did, like 475 basis point hikes in a row or something like that. But anyway, it was just interesting that what I heard and what I saw, his statements didn't really come across as being extremely dovish to me. But hey, what do I know? It's all about, I guess, suppose how the algos interpret what he said. And what he basically said is that there's a couple of more rate hikes coming, right? And that they were planning on holding interest rates, at their they weren't planning on doing anything except raising a couple more times and then holding interest rates high for the remainder of the year. And just those two simple facts, which is basically just reiterating what they've been saying all along. All these Fed speakers, right? They're they pretend, or they seem determined to bring inflation back down and make sure it doesn't resurface. I think that's what they're worried about, because obviously, inflation peaked last summer, and the CPI and the core PCE, the one they watch, has been coming down consistently, pretty consistently each month, and so they're bound and determined to get it back down to 2%, which is still, kind of silly considering their mandate is, stable prices and 2% inflation. But anyway, all that aside, to me it was mind-boggling how the market seemed to interpret what he said as being dovish for one thing, and or some sort of pivot because and so like today, right? Today there's like 4 or 5 Fed speakers. One of them's already out of the way. I think it was Williams or something like that. And Williams just came out this morning and said that, that they may have to maintain a restrictive stance for several years, which if I've learned anything over the years, it's to never assume that what the Fed says long term is what they're going to do, because obviously at the first sign of some sort of crisis, they're going to do what they normally do. And so what the Fed has done, as long as I can remember, is every single sort of crisis that comes along, they cut interest rates, right? And then usually, like, start QE, right? They've been doing that for so many years. But anyway, long story short, so the Fed hiked again. They're planning on hiking a couple of more times, even though the market's sort of calling their bluff on that. I think, maybe a couple places I read that the market is only really pricing in one more rate hike or whatever, but the idea that, the market kind of doesn't believe what they're saying is strange to begin with. But there's no question right now, looking at this weekly chart, and that the market, has quite a bit of short-term momentum. And technically speaking, purely objectively, and I know of people that say, oh, well, I don't watch the news, I don't pay attention to any of that stuff, I just look at the charts. And so, technically speaking, we can't deny that this downtrend line from last year has been broken, right? Now we've got an uptrend line. Interestingly enough, this retest came really, really close to the I always like to have the pandemic on the chart for perspective, I suppose. Until maybe like, this time next year, whatever, this'll drop off. But it really, the pandemic, the reaction to the pandemic, and the whole thing about the pandemic, the shutdowns in other countries, and just all the crazy stuff that went along with it. And of course, the Fed creating $6 trillion out of thin air, right around here. I guess it would have been in, April or May, probably May, April or May of 2020. It's going back a ways now. I mean, it's almost been a couple of years, but, the market sold off from top to bottom about 35% in a very short amount of time. So that's about the closest thing to a crash that, a lot of participants have ever seen. And anyway, boy, they sure managed to rescue the market. $6 trillion of spending, which I believe accounts for, the humongous rally that we saw. And quite frankly, along with this rally came some absolutely ridiculous valuations and speculation in the market. And so, a lot of charts and stocks that we look at, they got ridiculously overvalued is all you can say about it. I read a stat yesterday that said something like 40% of the stocks in the Russell 2000, the smaller stocks, are unprofitable, something crazy like that. But I mean, we saw like just insane stuff, tech companies or whatever with multi-billion-dollar valuations, just going parabolic for no reason other than, animal spirits, I suppose you could say. But anyway, all that aside, where we find ourselves now is kind of in the rebuilding sort of area. So what I'm thinking is this current rally seems to be getting a little bit long in the tooth, right? It reminds me a lot of the rally last July, and that was pretty much, as I recall, that was kind of based on the idea that, the Fed was going to pivot. And so you get this weird sort of environment where, and a lot of times last year, the economy's slowing down. Any kind of bad economic news was greeted by the market as positive. So it's like the old bad news is good news because I guess the participants assume that if the economy slows down, the Fed's going to be less aggressive with the rate hikes. And so that was primarily what accounted for the big rally last summer. And then, going into the end of the year, it was sort of the same thing. I mean, you watch, I have CNBC on, and it's muted now about 90% of the time. So there was a time that I would have the sound on most of the day and listen to what these people said, but it's getting old at this point. And so, but anyway, the term Fed pivot was just a constant thing that everybody talked about. And so the Fed has basically made it clear that they are not going to pivot, that they're going to take rates to around 5%, give or take a quarter point, 475, 525, whatever. But so, the Fed funds rate, the short-term interest rates are going to be around 5%, which actually seems reasonable. Um, and so, the strange thing here is that, well, there's a lot of strange things. I mean, there's always tons of pieces to the puzzle, and I don't pretend to be any sort of macro expert, but one of the pieces of the puzzle here is like all of a sudden there's just tons and tons of layoffs. Like literally, I think I talked about this last week. Literally, if you search like job cuts and layoffs in the news and go through, I mean, every single day it's another big well-known company laying off, 5 to 10% of their workforce. And so, I mean, that's just, the crazy thing about it, and the other thing that was really sort of strange recently, and I guess this was last week, was the employment numbers, which on the surface seemed like, well, on the surface it was like the lowest unemployment in 40 years or something like that, and the unemployment rate, and there's all these job openings and this and that. And then, you dig into it a little further and you start to see articles about seasonal adjustments, which basically, accounted for it. And so, it's kind of sad, but we've reached the point where we're like I say trusting or listening to just the headline economic numbers a lot of times is deceiving to some degree. And so you got to dig in further, but the market trades on, a lot of times just trades on like the headline numbers. And you see this when a company comes out with earnings, right? Whatever the headline number is, the market instantly interprets that as, a beat or a miss or whatever. And then, if you really dig into the details, you get a different sort of picture where, okay, well, this company beat earnings estimates, but the earnings estimates were lowered, 3 times in between their last earnings report and now. And so, yeah, of course, and so there's, there's a lot of that goes on. And the same thing with just about all the economic numbers. As a matter of fact, I'm pretty certain that going forward, the way that they calculate CPI, the inflation number, is going to be changed again. I'll have to look into that because that's everything's kind of revolving right now around inflation. And so, I mean, it's pretty simple economics. I think 40 years ago, I learned that when a government creates a whole bunch of money out of thin air, like the 6 trillion they did to offset the pandemic. We should started off the show talking about that. So, I mean, that's happened all throughout history. It's basic economics is when governments print money to, for spending or for whatever, that it waters down the current money supply, and that causes inflation. And so basically, I mean, that's what you got. The Fed's reaction to the pandemic caused the inflation, and so now they're trying to solve the problem that they created. So, and they always just go hog wild. They don't just I mean, they slashed interest rates to zero. And the funny thing is prior to the pandemic, there was some weird stuff going on with reverse repos and all this kind of stuff. And I remember there was some really odd sort of stuff happening behind the scenes. They called the plumbing of the market that was prior to the pandemic. And of course, prior to the pandemic, they pretended for years that there was no inflation. As I said, every time I went to the store, I noticed the price of the stuff that I buy going up, and they kept saying there's no inflation. So, I mean, it's just a funny sort of thing. But anyway, getting back to the market and where we are here. Um, right now, the market has a lot of momentum. There's a lot of buyers coming in, and I mean, hey, that trend is your friend, right? So downtrend line broken on a weekly basis. We got a nice little uptrend line working here, and I could probably move this. It's not really the same, but it is kind of a parallel line, to be honest with you. So I mean, it's close enough to be in a parallel line. So let's see if I can draw another one down here. Yeah. So, we're basically in sort of an up channel here. One of the things that kind of bugs me a little bit about this is it's tough to know where to start this line from. I mean, in theory, well, I mean, there's the close right there. So it's pretty close to a this is pretty close to a parallel channel. I didn't adjust the angle of this. I just moved it up. So there we go. In theory, there's some upside here. We're getting a little stretched though. The market's getting a little stretched sort of on a weekly basis. And oh look, Steve Leisman, here's the headline on CNBC: Fed officials warn of even higher rates. Right? So now they're looking at like almost 5.25. Huh, interesting. So here's the thing: a few basis points. It went from like 4.63 to 5.2 or whatever. But interest rates are going to end up around 5%, give or take. Like I said earlier, give or take, and they're planning on holding them there all year, if not longer. Right? And so what they really want is some sort of an economic slowdown, right? I mean, the cure for, and I've said this before, the cure for the solution to inflation is a recessionary sort of environment. And then, of course, you get into that whole thing about the soft landing. Can the Fed engineer a soft landing? You hear talk about that all the time, but thing of it is they've actually, what's kind of interesting now is that the Fed has bought them, and they spent, oh my God, I mean, it's been so long since they've been in a position where if they need to, they can cut rates. And so basically, they're going to keep raising rates until the economy slows down enough that theoretically, unemployment's going to go up, and Powell said there's going to be pain. And so I think that, and I'm sure you've heard this before, that it takes like 6 months for each rate hike takes like 6 months to sort of work its way through the economy. And so it's going to be interesting to see what happens, in the next couple of quarters, because all these rate hikes are going to start hitting. And so here's something else, and somebody I see a lot of people, but somebody was on they interviewed someone earlier today, and she made a really good point, and this is a really important point, is that all of a sudden now, with interest rates having gone up significantly, the risk-free rate, I mean, totally risk-free of buying, short-term bonds or even, intermediate-term bonds, is you can get a decent rate of return again, right? I mean, for the longest period of time there, with interest rates at zero, they basically forced retirees into risk assets. I mean, they forced everybody on the planet into risk assets because you couldn't earn any money, with a bond paying 0.25% or whatever. And so now, being able to lock in, rates for, somewhere 4 or 5% risk-free rate of return in bonds is a pretty big deal. So, I mean, if you have a retiree with $1 million, once you start getting, 4 or 5%, that's 40, 50 grand a year without having it at risk in the market. So bonds are definitely going to compete with, start to compete with stocks. Um, but anyway, all that aside, um, this little area where this uptrend line and the downtrend line cross, this little area here would be a good spot for retracement. It really would be. So I think, well, personally, not just me, but I think last week the reaction to Powell last week was kind of took a lot of people by surprise. I don't know, the markets seem to have had quite a bit of momentum, but it took a lot of people by surprise because now all of a sudden it cleared all that resistance that we were talking about. See, that was the other thing, is let me figure out where I had this line here. Um, yeah, well, somewhere, remember, I had a zone. That's what it was. I had this zone of resistance, and it basically sort of plowed right through that. So in theory, can I make this a different color? Oh yeah, yeah. Let me do that just for the fun of it. Make that a different color, because that zone is still sort of in play. And like I said, I had more of a zone, but I talked about significant overhead resistance, and basically these couple of weeks right here last fall, and obviously like this low back here. Oh, this low back here, and these lows and these closes, right? I think we looked at the monthly. Let me go to a monthly just real quick. Um, yeah, so that's really close to where it was on the monthly chart. I think I had it somewhere like right around here because of all these monthly closes right around this level. I mean, there was a lot happening basically at that level, and it was more of a zone from the highs of these couple months to all these sort of closes here. So, but you get the idea. Anyway, back to the weekly chart. Um, the market has managed, amazingly enough, even with all, what I think is kind of a hawkish tone to what the Fed keeps saying. The market is like, it's like calling their bluff, which is actually kind of humorous because I mean, all these as long as I can remember, all these Fed speakers, they come out and they say, hey, we're going to have to be restrictive. Interest rates are going to continue to go up. We're holding rates at higher levels. We need to whip inflation now. And they just keep reiterating that over and over, and the market just shrugs it off and you know, at some point they're going to cave in and pivot, and or stop raising rates and then lower them. So and I mean, for that to happen, the economy's got to really suck. And so it's kind of it's very ironic what's happening right now. But here's something else too is they obviously they always say don't fight the market, right? But it seems that basic, basic, I don't want to say economics, whatever the word I'm looking for, dictates that, higher interest rates are, the lower that valuation should be, right? Just like home prices, right? Home prices, it's like a balancing scale, and the market is the same way. It's like a balancing scale, and so um, the PE ratios and valuations at higher interest rates are supposed to be theoretically, um, the old weighing machine, right? So valuations, were reasonable at lower levels, um, but all of a sudden, like valuations based on PEs and based on traditional valuation metrics are stretched up at these levels where we are. So I can't. If I was preparing for, to talk on an interview on CNBC, I would know what the PE ratio of the various indexes was off the top of my head. But I can just tell you that obviously earnings are slowing, right? And PE ratios now are extended, and you got a bunch of layoffs. So I suppose the other thing that's really ironic, I suppose you could say, is that these companies, they announce a layoff and then their stock spikes because of that, and they're like, well, they're trimming the fat. And so that's sort of and I remember in the past, same sort of phenomena, but that's how you get your stock price, a little bump in your stock price as you announce that you're laying off, X amount of your workforce or whatever, and then investors perceive that as, okay, well, this company's doing the right thing. Well, for one thing, they should have probably never hired those people to begin with, right? And that just it just seems kind of strange. And so I guess there's a lot of middle management and fat to trim out there still, but you would think that, over the last decade, all of these companies would have become extremely efficient and not gotten all bloated, hired a bunch of people they didn't need to. I think, was it Google that was laying off like, massage people and like really ridiculous stuff. And so anyway, yeah, go search for layoffs, or search, you search the news for job cuts and layoffs, and it's basically a who's who of the S&P 500 is laying off, somewhere between 5 and 10% of their workforce, and thousands of people. So it's going to get interesting. The market itself is probably due for a little bit of retrenching back towards 4,000, right? So interestingly enough, I mean, we're still kind of in the thick of earnings season here. So, but we're starting to get some in the system is starting to actually identify now that this trend line's broken and we're getting some forward progress and the technical picture is sort of shaping up. The system is beginning to actually identify some swing trades here, and with the biggest caveat being that we're still kind of in the thick of earnings season here, and so I've noticed that some of these potential swing trade setups are companies that are going to be releasing earnings maybe in a few weeks. So generally speaking, I kind of go through them and manually, and if they're going to be releasing earnings like in the next week, then I have to suppress them. But if it's a few weeks out, we've seen over the years, we've seen plenty of stocks and companies that have the pre-earnings run-ups. And so anyway, yeah, I think it looks to me like, well, depending on what today is, we're down a little 0.5% today, but it won't surprise me to see the market retrench a little bit. Obviously with momentum like this, geez, it could be gunning for this upper trend line, but I think at some point reality is going to set in a little bit. Fair value, like the fair value based on everything that, you take all the pieces of the puzzle and put them on each side of the scale. And so somewhere around 4,000 is probably, more reasonable. Once earnings season's, completely over, and then we'll know, like the PE on the S&P and all that good stuff. But yeah, and here's the thing is like at this juncture right here, probably the best thing for the market would be a little retrenching back towards 4,000 rather than getting like really extended. So if they decide to run this thing up, to this upper trend line, we may have an inside week here, but hey, who knows? They could continue to run it up here, but as dysfunctional as the current environment is, quite frankly, um, like I said before, the market seems like it's a little delusional, and right now we're getting back into these animal spirits, and that's the last thing that the Fed wants. I mean, um, it's like they've lost most of their credibility, which is kind of funny to say because I mean, for as long as I can remember, they seem to get everything wrong, right? Remember inflation being transitory, and I'll tell you, there's something else about inflation. And then I'm going to wrap this up. Is the funny thing is that so the last 4 or 5 months, inflation peaked and has been coming down, and all of a sudden I go to the store and it's like the prices went up again of this stuff that I buy. And I'm like, wait a minute, the idea. And so, it goes back to what I settled probably a long time ago, multiple times, is that, you know, when inflation goes up and the price of everything goes up, when inflation starts to come down, right? When the rate of inflation starts declining, that doesn't mean the prices are coming down. It just means that the prices just stay high, and they just don't raise the prices as frequently and as quickly as before. But I'll tell you what, man, I go to the store now and I'm shocked at the price increases from like just a few months ago. And so that's the funny thing about inflation is they lead you to believe that when inflation comes down, most people think, your average person that doesn't pay attention to this stuff, it's like a subconscious mind trick. They say, "Oh, inflation's coming down" on the news, and people think, "Oh, good, they're going to lower all the prices at the grocery store," but that's not how it works. So once you let the inflation genie out of the bottle, right? And then the price of everything goes up. If the Fed is able to bring the inflation rate back to 2% over the next couple of years, well, guess what? Everything's still going to be, just as expensive as it was. It's just not going to go up in price as frequently and as much and as often. But, the whole general price level of everything, generally speaking, obviously there's some things that, are on sale, or, certain people just won't pay certain prices for things. But anyways, they made a real mess out of this whole thing. So, um, I'm a little leery and reluctant to, sort of want to chase prices here, but theoretically, if we can get a retrenchment in the next couple of weeks back towards 4,000, then then that's kind of gonna represent what I think is probably where the market should be. So may have gotten a little ahead of itself, and so we'll just have to see. But of course, right now there's plenty of stocks that have fairly decent setups on the charts, and so we got some pending right now, and couple pretty close to triggering in. So we'll just have to see what happens with that. So you can check the pending list and see what's going on the inside. And as earnings season starts to trickle through, I expect to see that list get longer and longer, and so we will have some opportunities coming up. So anyway, thanks for tuning in, and I will be back next week, same time, same place, and I will see you then.